All right, let's talk about something most of us would rather not think about. Taxes, right? It feels super complicated, maybe even a little scary. But what if I told you it's just a game? A game we're playing, whether we like it or not. The thing is, nobody ever really teaches us the rules. Well, that changes today. Over the next few minutes, we're going to learn how to play this game, and how to play it well.
Wow, I mean, this quote just hits so hard, doesn't it? Plain blind. That's exactly what it feels like for so many of us. And the crazy part is, people are literally giving away their hard-earned money just because the basic rules were never explained. So that's our mission here today, to give you that explanation. We're going to flip the lights on so you can see exactly what's going on.
Okay, let's get right into the big one. You know the one I'm talking about. Maybe you've heard it from a coworker, a friend, maybe you've even worried about it yourself. This idea that if you get a raise, you'll get bumped into a higher tax bracket and actually end up with less money in your pocket. Sound familiar? Well, let me just say it right now. That is, without a doubt, the single biggest, most persistent myth about taxes in America, and today, we're going to smash it to pieces.
So how do we bust this myth? Well, it all comes down to understanding something called a progressive marginal tax system. Whoa, okay, I know, that sounds super boring and academic, but stick with me here, because the actual idea behind it is incredibly simple, I promise. Let's break down how this whole tax bracket thing really works.
Okay, here it is, the absolute key to understanding everything. The myth, the one that scares everyone, is that if you're in, say, the 22% tax bracket, your entire income gets taxed at 22%. But that's not how it works, not even close. The reality is our system uses, well, think of them like buckets. You've got a bunch of buckets lined up, each with a different tax rate. You start filling the first bucket, the one with the lowest rate. And only when that one is completely full does your money spill over into the next bucket, which has a slightly higher rate, and so on.
Let's look at the actual buckets for 2024. See this? Everybody, from a new grad to a CEO, pays just 10% on their first $11,600 of taxable income. That's bucket number one. Once that's full, the next chunk of your income, up to about $47,000, is taxed at 12%. It's only after that bucket is full that you finally start paying 22%, and only on the dollars that fall into that third bucket. See? It's step by step. Your whole salary is never, ever taxed at just one rate.
Okay, theory is great, but let's make this real. Let's say you have a taxable income of $60,000. You'd look at the brackets and see that $60K falls into that 22% bracket, and you might think, oh great, I'm losing almost a quarter of my income to taxes. But hold on, that's not the whole story. Let's actually run the numbers and see what happens. So, we're pouring that $60,000 salary into our buckets. Watch this. The first $11,600 goes in the 10% bucket. That's $1,160 in tax. Simple. Then, the next chunk, about $35,550, fills up the 12% bucket. That's another $4,266, and now, what's left over? Only that last little bit, just under $13,000, is what actually spills into that 22% bucket. So only that portion gets taxed at 22%. So when we add all those pieces together, you might be surprised by the final number. And here it is. The grand total tax owed on that $60,000 salary is $8,253. So what does that actually work out to? It's an effective tax rate of just 13.8%. 13.8. Just look at that number. It is nowhere close to the 22% you were worried about. This is the proof. This is the math that shows why a raise will never, ever cost you money. You will always, always take home more. Myth busted.
All right, so we've tackled the biggest mental hurdle. Awesome. But now let's get down to brass tacks. You get your paycheck and you see the top line number, your salary, and then you see the number that actually lands in your bank account. And they are very different. So where does all that money in the middle go? Let's decode that pay stub.
So you've got your gross pay, right? That's the big number, the total you earned. Then you have your net pay, which is what you can actually spend. And that gap between them is filled by a few usual suspects. You've got your federal and state tax withholding, which is what we've been talking about. Then you've got something called FICA taxes. And finally, there might be some pre-tax contributions, which we'll get to in a minute.
Let's zoom in on FICA for a second. This is different from the income tax brackets. FICA taxes are a flat rate. It's simple. 6.2% of your paycheck goes to Social Security, and another 1.45% goes to Medicare. And here's the key part. Your employer matches that contribution. So this money is specifically earmarked to fund those big social programs.
Now here's a mindset shift for you.
That money taken out for taxes each paycheck, it's just an estimate. It's your employer's best guess. And that big, exciting tax refund you might get in April, I hate to break it to you, but it's not a bonus. It's not free money. All it means is that you let the government hold on to too much of your money all year long. You basically gave them an interest-free loan. The real goal? To get as close to zero as possible.
Hey, just a quick pause. If you're having any of those aha moments and finding this useful, do me a favor and hit that subscribe button for the Growth Mind. We put out clear, super actionable explainers like this all the time, designed to help you get ahead. Okay, let's get back to it.
Okay, so we've got the defensive game down. We understand how taxes are calculated. Now, let's talk offense. How can you actively, legally, lower your tax bill? This is where we get to the power-ups, and it all starts with understanding the massive difference between two words that sound similar but are worlds apart: deductions and credits.
Pay close attention here because this is huge. A deduction is good. It reduces your taxable income. Think of it like shrinking the target that the government is aiming at. But a credit is a superpower. It's a direct dollar-for-dollar reduction of the final tax you owe. It doesn't shrink the target. It just erases part of the final bill. That's why credits are almost always way more powerful. And this really drives the point home. A $1,000 deduction, depending on your bracket, that might save you a couple $100, which is nice, but a $1,000 credit, that saves you $1,000, period. It's like a gift card you hand directly to the IRS. It's a pure discount on your final bill.
So when we talk about deductions, how does that actually work for most people? Well, thankfully, it's pretty simple. There's something called the standard deduction. It's basically a freebie, a fixed amount that you get to chop off your income right from the start, before any of the tax bucket math even begins. And honestly, this amount has gotten so big in recent years that about 90% of people just take it. It's the easy, automatic win.
All right, we've talked about deductions. Now let's talk about what is probably the single most powerful proactive strategy that almost anyone with a job can use to lower their taxes. I'm talking about using pre-tax accounts. This isn't just defense. This is your absolute best offense. The magic here is just so elegant. When you contribute to something like a 401k at work, that money is taken out of your paycheck before the IRS even sees it. So check this out. Say you earn $70,000, but you decide to put $10,000 into your 401k. Poof! As far as the tax man is concerned, your income is now only $60,000. You're saving for your future, and you get an instant tax cut at the same time. It's a win-win.
But wait, there's more. If there's a superhero in the world of tax-advantaged accounts, it's the Health Savings Account, the HSA. This thing is unbelievable. It has what they call a triple tax benefit. Ready for this? 1, the money you put in is tax deductible. 2, that money can be invested and grow completely tax-free. And 3, when you pull it out for qualified medical expenses, it's also tax-free. In, growth, and out, all tax-free. There is literally no other account like it.
So let's just pull back for a second. What's the big takeaway from all this? I hope it's that the tax code isn't some big, scary monster designed to cheat you. It's not your enemy. It's just a rule book. That's it. A set of rules for the game. And now you actually know some of the most important rules. You know how to play.
So I want to ask you something before we go. As you think back on everything we just flew through, the whole myth about raises, the buckets, tax credits, the HSA, what was the one thing that made you go, whoa, I never knew that? What was your big aha moment? Or maybe, what's the one thing you desperately wish someone had sat you down and explained when you got your very first job?
Drop your answer in the comments below. I really want to know what clicked for you. And hey, if this explainer cleared things up, make sure you're subscribed to the Growth Mind so you don't miss the next one. Thanks so much for tuning in.